Greetings, everybody. Rene, CIO at Single Point. Today, I wanted to address some of the questions we've been getting about Bitcoin and cryptocurrencies in general. And so we put together this brief video just to share our impressions of what's going on. So why don't we start by looking at this graph here. This is the Bitcoin valuation graph going back to about 2015. So obviously you see here in late 2020 and the beginning of this year, Bitcoin price just skyrocketed from around $15,000 per Bitcoin north of $50,000. All right. There had been a more recent peak back in late 2017, early 2018. And this really goes to show the volatility of this particular investment. Even if we go back 2 years, you'll get a better sense of the magnitude of the swing that it peaked in the initial wave of buying in late 17. It peaked at north of 18,000, and then it just collapsed all the way down below $4,000. So almost an 80% correction, right? And then we fast forward to now, right? And now we see this move up. For most of 2019 and 2020, it was range bound. And then towards the end of the year, we see this massive spike. Bitcoin, of course, is finite. There's only going to be 21 million Bitcoins mined. So to the extent that the demand outstrips that limited supply, obviously we would expect to see these kinds of upward moves in the price. But what's the difference between this rally here and the rally from 3 years ago in late 2017? And recently, there's been a lot of financial press, and a lot of the Wall Street folks have been beginning to create a momentum to persuade institutional investors, pension funds, endowments, RIAs like Single Point to allocate capital to Bitcoin. We have not done so up until now, nor, by the way, do we expect to do so at any, in the near future. But in terms of just understanding the difference between the 2017 rally and the rally that we're currently in, I think this headline captures it well. JP Morgan says Bitcoin could rise to $146,000. It's a little bit over $50,000 now. So JP Morgan is basically calling for it to triple even from the levels that we are now. And what's the premise? What's the thesis around JP Morgan's belief? JP Morgan and a lot of the other Wall Street banks and pundits and commentators are promoting Bitcoin and cryptocurrencies as an alternative to gold. Okay? It is like gold in the sense that it's finite. It is like gold in the sense that it doesn't pay any income or yield. And unlike gold, so far, Bitcoin has not shown to have any intrinsic utility, right? So gold has industrial purposes. In fact, gold is used as part of the semiconductor and chip manufacturing process. And of course, gold's very popular on the jewelry front. Neither of those two applications are relevant for Bitcoin, at least at this point. They've talked about Bitcoin potentially becoming like a currency, like a digital version of cash, but quite frankly, with the volatility and more importantly, the fact that it's taxed as an asset and not like cash, creates some pretty significant hurdles for it to be widely adopted, at least at this point, as a form of payment. Of course, that doesn't mean that there aren't headlines out there of MasterCard and PayPal. BNY Mellon, my former employer, has now come out and said that they want they want to be able to provide custodial and tracking services for Bitcoin assets and other crypto assets. And all that is feeding into this press frenzy around Bitcoin. And There's a lot of hot money, a lot of speculative money that has flowed into it, and that's, I think, what's driving this particular move up. I want to just spend a couple of minutes analyzing the underlying premise of this JP Morgan headline, and the strategists at JP Morgan are basically saying, the narrative says, look, because of the pandemic, the federal government has really run the credit card, casually speaking, in a massive way, and running big deficits to stimulate the economy and get everybody back into full employment. And those kinds of deficits, at the same time that the Federal Reserve has kept interest rates so low, are very likely to create an inflationary environment down the road. Historically, gold has done better in periods of high inflation. Here, let me show you a graph. So this is a graph from 1979 through the mid-80s. And during this time period, gold had its heyday. And gold, which is the purple line, basically doubled in value from 79 to 83. At the same time, the S&P 500, which is in orange, was up 46%. So in this little window in time, gold actually did better than the S&P 500. It's notable because it's rare. Most of the time, the S&P 500 does way better than gold. But in any event, by the way, the light blue line is the CPI, the Consumer Price Index. So that's a measure of inflation in this country. And you can see that the S&P 500 barely kept up pace with inflation, whereas gold during this time period basically doubled in value and outstripped the return on both. And so there's this narrative out there that once again, if inflation gets out of control, that assets like gold, quite honestly, real estate's another hard asset that usually does very well in inflationary periods, would do better. And there's an argument that the JP Morgans of the world are putting out there that in that case, you want to have something more than just stocks and something more than just bonds to hedge or protect, immunize yourself against the effects of inflation in your portfolio. So let me show you another graph, right? So this is a 30-year look back of the U.S. total stock market. Okay, the green is a 60-40 portfolio, 60% stocks, 40% bonds. Purple is gold, and the light blue is the bonds. So you can see that over the last 30 years, gold's return has been solid. It's almost quadrupled in value. But the good old reliable 60-40 plain vanilla portfolio of stocks and highly rated bonds was up 600%, which means that it was 7 times. It was a growth multiple of 7 times had you put $1 in 30 years ago. So yes, there are periods in which gold can outperform. It's not entirely clear what drives the outperformance during those periods, because in this period from 09 to 15, when gold did better than the 60-40, there wasn't actually a whole lot of inflation. In fact, inflation was very subdued. We were coming out of the Lehman Brothers crisis. And if anything, there was a tremendous amount of excess slack in the economy. And inflation was very subdued. Nevertheless, that's the narrative that we're hearing. The view at Single Point is one where we don't fully understand the drivers of the Bitcoin price. It seems like that more people buy when the price goes up higher, which seems counterintuitive to me. I think that there is a very hard time explaining to someone what is the fair market value of Bitcoin, because we don't understand the way this thing is priced or what a fair market value might be. And because of the volatility, we don't feel like it has a role to play in client portfolios. And that's independent of our view of inflation going forward. Now, if someone asked me what is our view of inflation, I would say inflation continues to be abnormally low. It's been abnormally low for a very long time. Here's an inflation chart going back to the late 1960s, right? So you see that inflation spike in the 70s and in the 80s, right? A lot of our clients that began investing in this era, right, have very negative memories of how difficult of a market it was. The stock market was difficult because of this inflationary outburst, which was really unlike anything that the country had ever experienced, going even before the Great Depression, and then going forward. What we've seen is a steady decline in inflation, and today we're sitting at about 1.6%. So incredibly low. Could inflation go higher? Probably. In fact, that's the stated policy objective by the Fed. Will it go back up to what it was in the late 70s and 80s when gold did really well? I think it would take a very rare confluence of events for that to happen. We don't see that happening anytime soon. There could be a modest uptick in inflation. Probably there will be as we get beyond the pandemic. But I don't think it's a risk at this point that is, in our minds, that would justify allocating dollars either to gold, real gold, or digital gold like Bitcoin. Hopefully this is illuminating and helps provide a little bit of context on how we're thinking about Bitcoin. I'm happy to answer any questions. Cheers.